You know, whole life insurance gets a really bad rap for being expensive. But what if I told you there was an insider's playbook? A series of specific, strategic moves you can make to slash the cost without destroying the benefits. Well, that's exactly what we're going to walk through today. Let's dive in.
So let's just get it right out there. Is whole life insurance a ripoff? I mean, it's the first question on everybody's mind. You hear about these high premiums and all the complexity, and it's totally natural to be a little skeptical.
And the brutally honest answer is, yeah, it absolutely can be a ripoff, but only if you go in blind, without a playbook. See, the right strategy doesn't just save you a few bucks, it completely flips the script on the entire value proposition.
The reason it's expensive is pretty straightforward, actually. You're bundling 3 really powerful guarantees into one contract, a death benefit that lasts your entire life, premiums that are guaranteed to never go up, and a cash value that's guaranteed to grow. To get the best possible deal on a package that powerful, you gotta have a game plan.
So, let's open the playbook to Chapter 1. This is where you can win the game before it even starts, the shopping phase. These are the moves you make before you ever sign a single application. And trust me, they set the stage for everything. Okay, first move, and it's absolutely critical. You want to work with an independent broker, not a captive agent. See, a captive agent works for one company, so they can only sell you one thing. But an independent broker, they can shop your case around to dozens of carriers, basically forcing them to compete against each other for your business. And that competition, well, that's how you find the real value.
All right, here's a true insider tactic that most people never, ever hear about. It's called the underwriting pre-check. Think of it like your secret weapon for getting the absolute best health rating without risking a formal no on your permanent record.
And the process is so simple, it's brilliant. Your broker sends an anonymous health profile, no name, just the facts, to a bunch of insurers. Their underwriters take a look and give you these informal, non-binding offers. You get to see who comes back with the best deal, and then you formally apply only to that one winner. No surprises, no declines on your record, you just target the best price from the get-go. Now, I want you to burn a number into your memory. 12. If you use nicotine in any form, quitting is the single biggest thing you can do to lower your premium. And why 12? Because most insurance carriers require you to be completely nicotine-free for at least 12 months before you can qualify for their much, much cheaper non-tobacco rates.
And check this out, timing is literally everything. Most insurers use something called your age nearest birthday. Basically, if you apply in the 6 months before your half birthday, they price you at your current age, but if you wait until after, boom, they round you up to your next birthday. Getting this right locks in a lower premium for the rest of your life.
Okay, so we've shopped like a pro. Now it's time to design like an architect. How your policy is actually built on the inside is another massive lever you can pull to slash costs and seriously boost performance.
This brings us to probably the most important term in policy design, paid-up additions, or as we call them, PUAs. The best way to think of these is as a turbocharger for your policy. You're paying extra premium to buy these tiny, fully paid-up mini policies that get bolted onto your main one. And these PUAs, they dramatically accelerate your cash value growth right from day one.
I mean, just look at the difference it makes. The bar on the left, that's a standard policy with almost no PUA funding. See how slowly that cash value builds? Now look at the bar on the right. That's a policy engineered from the ground up to maximize PUAs. The early cash value is just worlds apart. This, right here, is the secret sauce to an efficient policy. Here's another powerful design trick, blending. So instead of buying $1 million of pure whole life, you can buy a smaller whole life base policy and then add a really cheap term insurance rider on top to get to that same $1 million death benefit. The premium is way, way lower. The catch, of course, is that the term part of it will eventually expire. And hey, want a simple hack for an instant discount? Pay your premium annually. When you pay monthly or quarterly, there are little billing fees baked in that can add up to as much as 8% over a year. Pay it all in one lump sum, and those fees just vanish. Okay, so what if you're sitting there thinking, this is all great, but I already have a policy. Are you just stuck? No way. The playbook has moved for you too. This section is all about optimizing the coverage you already own and making it work harder for you.
This is a big one. It's called a 1035 exchange. The tax code literally allows you to roll the cash value from an old, clunky, underperforming policy directly into a new, high-efficiency one, and you do it all without creating a taxable event.
It's just like trading in your old gas guzzler for a new Tesla and not paying capital gains on the trade-in. It's huge.
Now, if you just need to lower your current bill, you have options. You can call the carrier and ask to reduce the death benefit, which will lower the premium. You can look at the riders you have, maybe a child rider for kids who are now grown up, and remove them. Or if you want to stop paying completely, you can elect what's called a reduced paid-up option. This uses your cash value to buy you a smaller, permanent death benefit that requires 0 future payments. And if your policy pays dividends, what you do with them is critical. The absolute most powerful option for long-term growth is to reinvest them to buy more of those paid-up additions we talked about. It creates this amazing compounding effect. Using them to reduce your premium is a solid number 2 if cash flow is tight, but taking them as cash, almost always the worst option. It can create a tax bill, and it slams the brakes on your policy's growth.
Wow. Okay, we've covered a ton of ground. So let's lock it all in with a final rapid-fire checklist. This is your winning game plan simplified.
First up, before you buy, always use an independent broker. Always demand those informal pre-checks. Time your application for before your half birthday and pay annually to skip the fees. Got it? Good.
Next, when you're designing the policy, blend it with a term rider to get a big death benefit on the cheap. Design it to maximize those super powerful PUAs and only pay for the riders you actually need.
And finally, if you already have a policy, review it to see if a 1035 exchange makes sense, look into reducing the face amount to cut your premiums, and for goodness sakes, use your dividends to buy more PUAs.
At the end of the day, this entire playbook, all these moves, it all boils down to one single goal. Your job is to minimize what you pay for every single dollar of protection and every single dollar of cash value you get in return. Period. A whole life policy, when you structure it the right way, isn't just an expense. It is an incredibly powerful financial asset. So the final question is pretty simple. Are you designing yours to win